on the Fed rate decision is Dean Baker. He's co-director of the Center for Economic and Policy Research right here in Washington, D.C. So what are the risks of doing nothing? What are the risks of just marginally changing the rates as we see here?
Well, I think the Fed made the right call in making it a marginal increase and in indicating that future increases will be very much data-driven. Because again, the point here is the Fed is always looking on the one hand, is the economy too weak, in which case you want low rates, try to boost the economy, or is there a risk of inflation? Raising the rates, obviously they felt there was some risk of inflation. I think that was overblown. But the point here was that they indicated any future hikes will be driven by the data. And if, as I and many others think, that the data is going to show the economy is relatively weak, then we aren't going to see many future rate hikes. The indication is perhaps 4 over the year. My guess is we'll actually see less than that because I think the economy isn't going to be strong enough to justify 4 rate hikes.
Was the number right, what she landed on, you think?
Well, again, I would have rather seen nothing because, if you ask the basic question, is the economy growing too fast or too slow? My answer is too slow. Why make it slower? Realistically, does a quarter point have very much impact? No. So in that sense, I'm not too upset about that, just a step in the wrong direction.
She talked at the news conference about inflation and employment. So talk to me, you were saying, the economy really isn't growing to the degree you'd like to see it, but where do you see an impact with this, raising the rates? I mean, where do we see perhaps some problems, some hiccups?
Well, this is going to have a modest upward pressure on interest rates across the board. So, of course, what we're talking about is this overnight rate that none of us see. This is the banks paying, on their reserves overnight. They're going to be paying 1/4 to 1/2 point instead of 0 to 1/4 point. We don't see this. But there's a whole set of interest rates that are going to rise, at least modestly, in response to that. So people getting car loans are going to pay a somewhat higher rate. Some people with mortgages, particularly an adjustable rate mortgage, you'll see a somewhat higher rate. Credit cards, you'll see a somewhat higher rate. So you'll see modest increases in interest rates across the board. Not a huge impact, but again, you'll be paying somewhat higher interest.
We asked Daniel about the global impact, other countries. Do you see any kind of ripple effect globally?
Well, I don't think it's a huge impact just because it's a modest increase, but you will see some impact. You will see, this is upward pressure on the dollar. That hurts our exporters. Our exporters have been hit over the last year because the dollar has risen. This pushes it up more. That's good news for countries that are big exporters, China, other East Asian countries, where I think you might see some problems in Latin America, because Latin America, they're going to face a tough choice. Many of those countries have higher inflation than they like. So if the dollar rises more, that's good for their exports, but that also means somewhat higher inflation. So they're going to be stuck in a situation. Do they try and keep their currency from falling, which means higher rates slowing their economy, or do they allow it to fall, and that means somewhat higher inflation?
Now, Yellen had kind of telegraphed for some time that they were going to do this. I mean, was this kind of an issue where they had to do something because they've been telegraphing it for so long, do you think?
They had almost locked themselves in, because if you go back to September, it was widely believed they would have a rate hike in September. And then there was some bad economic news here in the U.S. There was disruption in financial markets, particularly China, but some others as well. So I think Yellen worked out a compromise with the other members of the Federal Reserve, the Open Market Committee. Keep in mind, as a committee, it's not just Janet Yellen deciding on her own, that they would put it off in September. They would do it in December, barring some really extraordinary events in the economy. And certainly there haven't been any extraordinarily bad events in the economy. So I think everyone would have been quite surprised had she not raised rates.
All right, Dean, thanks so much for coming in and talking to us, providing analysis. Appreciate it.
Thanks for having me on.